Hi, good morning and welcome to this week's weekly roundup. I'm going to focus mainly on last week's budget today, going to add a bit more detail into some of those things, but I'm hoping that this won't be quite as long as last week's hour-long update. So yeah, I'm just focusing on what I think are the key aspects that are going to affect most of our clients and the things that we will be looking at over the next coming weeks and months. So we know that the last 12 months have been extremely tough for everyone, with lockdown restrictions and businesses having to close and everything else. And the government have paid out an extraordinary amount in support. And last week, the budget set out how that support will continue. Obviously, we've got this roadmap out of lockdown that takes us up to June, all being well. So how will the government continue to support businesses up until that point and slightly beyond in some cases? But then also it talked about how tax might change in the future to start to repay some of that funding back. So there are two bits of news, I guess, that came out of the budget that affect almost all of our clients. So the freeze on income tax thresholds and an increase in the corporation tax rate, which will apply from 2023. So the key budget headlines were no changes to income tax, national insurance or VAT rates. Personal allowances frozen from April 21 levels to 2026. So even though those rates are frozen, there is an expectation that income will rise over that period. So more people will hit the personal allowance threshold, more people will hit the basic rate band and the higher rate band. So by keeping the levels frozen, the tax that HMRC collect would expect to go up because people are earning more. Corporation tax, I think, was the big news, though. That's going to increase to 25%. Currently, it's 19%. So it's going to go up to 25% on profits over 250,000 from April 2023. If your profits are below that amount, if your profits as a company are below 50,000, then you'll still pay 19%. If your profit is between the 50,000 and the 250, then the profit in that range will be taxed at a slightly higher rate because you're into this marginal tax rate, which is something that we're very familiar with in the profession. This has come and gone in the past, so that'll be something that we'll be getting familiar with again in the next couple of years. Inheritance tax threshold, pension lifetime allowances and annual capital gains tax exemptions are also going to be frozen at the 2020-21 levels until 25-26. And so yeah, so most tax rates and levels are just being frozen. But like I say, I think the expectation is that the tax that will be collected will be more because more people will fall into those limits. There is a super deduction for investment in new equipment from the 1st of April this year, which gives you 130% tax relief. So if you buy something for £10,000, some equipment, then you'll get tax relief on 13,000. But I need to make a distinction here, it's only companies. So I was talking to somebody in a networking event earlier on in the week, and he sent me a private message via Zoom. Have you seen this? This is great news, isn't it? And we got chatting and I said, yeah, it is great news. It's a really positive thing. Then he said, or then I realized he was a sole trader. So it isn't going to be something that he is going to be able to benefit from. So yeah, just watch that. Companies only get that super deduction for investing in equipment. There's also an increase in how far back you can carry back losses. So the current rules are if you have a loss in an accounts year, you can carry it back to the previous accounts year and get a refund of the tax that you paid in the previous year to the value of those losses. So if your loss is more than the profit, then you won't you'll just get the tax that was paid last year. If your loss is less than last year's profit, then you get a pro rata amount. They've extended that to 3 years, so there will be businesses that were profitable 2 or 3 years ago, paid tax, and had maybe 1 or 2 years of real issues, depending on when their account year falls, but they'll be able to get more tax back than they would have done previously. So that is some good news and will help out some clients. That registration limit is frozen at 85,000 until the 1st of April 2024. Watch your rolling 12 months on that. Clients often get confused and think it's their turnover per their accounts that means that they need to, that will trigger will trigger the VAT threshold. It's not, it's just a rolling 12 months. So if you are a business below the VAT threshold, not registered for VAT, you need to be monitoring your turnover month by month to see if you're going to hit the VAT threshold in any 12-month period. And there are ways to avoid it, in the sense that maybe lots of small businesses don't open on a Monday or a Tuesday because they want to keep their income below the VAT threshold, because once they have to start charging an additional 20%, then it makes them very expensive to their customers and they might well lose business. So keep an eye on that, even if you're a very small business. There's some planning to be done around that. 5% VAT rate for food, attractions, accommodation. That's been extended and will return to 20% next year in 2 phases. I'll talk about that in a bit more detail later. Stamp duty land tax threshold, that was raised last year and was due to come back down again. That's been extended. Apprenticeship schemes have been extended. There are some new grants for high street businesses and hospitality sectors, particularly those that had no choice about closing. They were forced to close because of the pandemic. There's some grants for them. New business recovery loan schemes. So the initial schemes are coming to an end in March. New schemes are going to be introduced. Furlough schemes have been extended with some changes, again, which I'll talk about shortly. And the self-employment income support scheme has also been extended. We knew there was going to be a 4th grant. A 5th grant was announced last week, but it is different. So again, a bit more detail. I'll come onto that shortly. We did a quite detailed webinar last week on all of those things and a few other bits and bobs as well. Do check that out on our website or YouTube channel. And we've also prepared a PDF booklet if you prefer something to read, and that's downloadable from our website. Okay, couple of other things to quickly mention though that were announced in the budget is from 2023, so 2 years time, there are going to be changes to late filing penalties for tax. That's the same date of Making Tax Digital as well. So I'm not sure whether or not whether that was deliberate, but potentially there are going to be more issues going forward because there's more filing that's going to be required. But I'm speculating, I don't really know. But certainly those penalties are going to go up, and they're going to be linked to a percentage of the tax that should have been declared on that return, and that percentage increases as time goes on. So the £100 late filing penalty, it's been £100 late filing for absolutely years, and probably not a big enough incentive to encourage people to get their returns on time. I think this new penalty regime may well do that. So obviously, if you're our client, your tax return will go in on time, so you've no need to worry. But just be aware that if things do slip, then it's going to cost more in penalty. And also, the government are continuing to tackle tax avoidance schemes. We don't get involved with any of those in the office, though we have helped the odd client extract themselves from schemes and deal with HMRC on behalf of those. But there are going to be changes to penalties in that area, and new powers for HMRC to obtain information from financial institutions. And I think by that what they mean is the providers of these schemes. So yeah, do your homework if you're looking at these schemes, and make sure that you're not going to create problems down the line. Okay, so let's get into a little bit more detail. Changes to the coronavirus job retention scheme. So the current version of the furlough scheme started on the 1st of November and was scheduled to end at the end of April. So in order to avoid a cliff edge, I guess, get to the end of April and then still not, lots of business still not up to capacity trading, potentially at that point, the difficult decision to make redundancies. So to avoid that and enable a more measured, slow return back to normal working, the coronavirus job retention scheme has been extended. So the grant for May and June will remain at 80% of the employee's usual pay for the hours not worked, but then it will drop from 80% to 70% for July and 60% for August and September. But the employee will still receive 80%. So when they changed the scheme before November last year, they reduced the amount of support they were going to be passing on, and it's the same this time round. So the employer from July will pay 10% of the pay, 20% in August and September, in addition to the employer's national insurance and the pension contributions, which they have paid throughout on those furloughed employees. There is a table on the government website that gives a good indication of the sort of level of support, and the email that follows this webinar will give a link to that. So take a look at that or call the office. Our payroll team are amazing and they'll be able to help you with all of this. Okay, self-employment income support scheme. So like I said, we knew there was going to be a fourth grant. The budget has announced a fifth grant covering the period to the end of September. So hopefully by the end of September, we're all back to normal, and certainly the self-employment grant appears to be geared on that basis. And there is some good news as well. So when the first schemes were announced, there were some traders, sole traders, partnerships that previously weren't able to claim. So those that had commenced a self-employment business in the 2019-20 tax year, so they might have been trading for almost a year when the pandemic started and lockdown started, but because they hadn't done a 18-19 tax return, they weren't able to claim any support. So the good news for them is this time round they will be included, provided they have submitted their 2019-20 tax return by the 2nd of March. But the government estimate that potentially 600,000 traders will be able to access the grant you haven't been able to access before. So that's some really good news. So that fourth grant will be set at 80% of 3-month average trading profits, paid in a single instalment capped at £7,500, which is the same calculation as before, but the fourth grant will take into account the 19-20 tax returns. And like I said, will be open to those who became self-employed that year. The rest of the criteria in terms of being affected by lockdown and unable to trade remain. Conditions for the fifth grant will be linked to business turnover. So this is a change. Previously, it was the reported profit, so the taxable profit that had gone on the tax return. This fifth grant that's going to cover that period up to September will be based on turnover. So self-employed individuals whose turnover has fallen by 30% or more will continue to receive the full grant worth 80% of 3 months average trading profits, capped at £2,500 a month. That's similar to before, but to get that full grant, your turnover, your income needs to have dropped by 30%. Those whose turnover has fallen by less than 30% will receive a 30% grant capped at £950 a month. We are waiting further information about that. That's the extent of the guidance that I can see. How they capture that information, I guess, will be from the tax returns, but time will tell. So eligibility for the scheme will be based on your submitted 19-20 tax return. This may also affect the amount of the fourth grant, which could be higher or lower than the previous grant. So if your profit went up between the tax year 19 and 20, then you might get an increased grant. If your profit came down, then it may well be less. Sorry, the other way around. If your profit went up, you'll get more of a grant. Yeah, but if you're yeah, I think you know what I mean. Okay, to work out your eligibility, HMRC will look at your 19 to 20 self-assessment tax return. Your trading profits must be more than 50,000, no more than 50,000, and at least equal to your non-trading income. So this is the same as before, and we did have a number of self-employed clients who, on the face of it, would have been entitled to the grant, but they had other income more than the self-employment income was less than half of their total, so they might have had rental income or pension income, for example, so weren't entitled to that grant. So that's going to stay the same. So if you are not eligible based on your 1920 self-assessment tax return, HMRC will then look to tax years 16, 17, 17, 18 and 18, 19 and 19, 20. So they're going to look at not just the latest tax year. You must have traded in both tax years, 1920 and 2021, and have submitted your 1920 tax return by the 2nd of March 2021. You must either be currently trading but are impacted by reduced demand due to coronavirus, and have been trading but are temporarily unable to do so because of coronavirus. You must declare that you intend to continue to trade and you reasonably believe there will be a significant reduction in your trading profits due to reduced business activity, capacity demand, or inability to trade due to coronavirus. You need to keep your records. If you're making this claim, you need to keep records as to why you think you're eligible. So yeah, HMRC we're expecting a separate box to appear on the tax return, and so the inquiries perhaps will come in the future as to why you felt you were eligible to make that claim. So to allow HMRCs to process the recently submitted tax returns for 1920, the online claim service for the fourth grant will be available from late April. And I've looked this morning, I can't see anything more specific than late April. So that might be the 30th of April, I don't know. But it will be open from late April until the 31st of May. So quite a small window to apply. If you are eligible, HMRC will contact you in mid-April to give you your personal claim date. So they'll let you know when you can log in and make that claim. And again, you just need to make sure you've made that claim by the 31st of May if you're going to, because that's when it will close. There'll be more guidance on this in due course. So check into another one of these webinars, keep an eye on our website, register for our emails. You know, we're constantly sending information out at the moment because it's just so much change, like I've said before, that's happening. Okay, very quickly moving on to VAT. So the reduced rate for hospitality, hotel accommodation and attractions. So the reduced rate of VAT, so the standard rate is 20%. It was reduced to 5% for those businesses applying to supplies of food and non-alcoholic drinks for restaurants, pubs, bars, cafes and similar premises. That's been extended to the 30th of September. The 5% reduced rate will also apply to supplies of accommodation, admissions to attractions across the UK. From the 1st of October until the 31st of March, the rate will be increased to 12.5% and then revert back to the 20% from the 1st of April next year. So a phased return back up to that usual level. Make sure you've got good accounting software that it calculates that correctly. If you're VAT registered, you should be making tax digital compliant, so you should have proper software in place to be doing your VAT return. So my expectation is that that software will deal with that for you and work it out correctly, but do check depending on the software that you use. Okay, the recovery loan scheme. So the bounce back loans and the CBILS loans come to an end at the end of March. From the 6th of April, a new recovery loan scheme will provide lenders with a guarantee of 80% of eligible loans between 25,000 and 10 million. So they're making funding available as easily as they can to encourage businesses to take out those loans to invest in their businesses to be able to bounce back from this period of lockdown. The scheme will be open to all businesses, including those that have already received support under the existing guaranteed loan schemes. So the recovery loan scheme ensures businesses of any size can continue to access loans and other kinds of financing up to 10 million, providing support for businesses to recover. My massive, huge caveat about loans is cash flow. Cash flow. You're going to have to pay it back. So the example I gave often is last year when the £50,000 bounce back loans were available. A typical bounce back loan was £50,000 for 6 years. That's £900 a month repayment when the time comes to make that repayment. So if coronavirus, pre-lockdown, could your business have afforded to have made a loan repayment of £900 a month? So whilst I totally understand the need to perhaps use that money to see you through so you can start again, before you take out any funding, you must think about when, and it's impossible to know perhaps when you will get back to normal, but you need to do that exercise of going, okay, well, what's my cash flow going to look like in the future? Because I'm going to have to pay this back. And sitting alongside that is the VAT that was perhaps deferred last year. That's got to be repaid either by the end of this month, or you need to put a payment place in with HMRC. So, you know, there's lots of things that were parked last year. They're going to have to start to be repaid. So cash flow. And if you're on Xero in particular, and there are other accounting packages, but Xero have a partnership with a really good app that can take your Xero figures and predict your cash flow. So talk to us about that. It might be easier than you think to map out what your cash flow is going to be over the next however long you need it to be. Okay, I'm not going to talk any more about those loans because I'm very conscious of the time. I said I wasn't going to speak for long and I've already been rattling on for 20 minutes. So I'm going to just scoot down to grants. So some new grants. So the loans are great, but you have to pay them back. The grants, if you're eligible for a grant, you don't have to pay them back. So they're obviously even better. Businesses forced to close due to coronavirus lockdown will be eligible to apply for grants of up to £18,000, depending upon the rateable value of their business premises. So pubs, restaurants, hotels, gyms, hairdressers, and similar. You know, that's not an exhaustive list, but those are the ones that in particular have been mentioned. They'll be eligible for a grant of up to £18,000 per premises. Whilst non-essential retail businesses, so if you're a shop in any other sort of sector but you've had to close your in-construct, non-essential retail businesses will be eligible to apply for a grant of up to a maximum of £6,000. So those grants are intended to contribute obviously towards your fixed costs during this period of not being able to trade. And you will need to apply to your local authority for those. I haven't got a great deal of information on them other than a link to the government website, which will probably send you off to your local authority website. But look at those grants. They're going to be much needed, I think, to help you get back on your feet when you reopen again, if you've had to close. Couple of minor things which are important, particularly if you're running a business. So free rapid tests for all businesses for regular workplace testing and income tax exemption for employer reimbursed coronavirus antigen tests. Sorry, that was a bit of a mouthful. So workplace testing now available to all businesses, including those with fewer than 50 employees. So businesses are encouraged to register interest by the 31st of March to access the free workplace testing. So if you've got any employees, I encourage you to get online and register for that. The link will be in our follow-up email. So regular testing, you know, if you do have people that need to be coming into an office, regular testing could make a difference. And just as a personal note, my daughter is back at school this week. She's year 10. And they had a test on Monday when they went back in. They had a phased return. She went back in mid-afternoon, and then they had another test yesterday. And the test yesterday, somebody in her year group had no symptoms as tested positive. So we believe these tests are only 60% accurate, so it might be a false positive. But nonetheless, if they are picking up positives where there aren't any symptoms, then that's got to be a good thing. So yeah, the link will be in, register to get those tests so that you can have those in your workplace if you feel it's appropriate. Continuation of the home office equipment expenses easement. So obviously most businesses, we're one of them, everybody's working at home. We've invested quite heavily in laptops and various other bits and pieces to enable our staff to work from home effectively. An income tax exemption and corresponding national insurance disregard were introduced in the current tax year 2021, and this allows employers to reimburse employees for the costs of that equipment deemed necessary to work from home as a result of the COVID outbreak. That exemption was due to end on the 5th of April, but it's been extended another year. So you might not have realised that there was a potential tax issue by reimbursing staff for those things. They removed that problem, and obviously because it would have just made life even more challenging all round. I've already talked about the loss carryback. So if you do make a loss, you might well get a tax refund. So again, planning point there, get your accounts to us as soon as you can. Get those accounts done sooner rather than later to see exactly where you are. And if you are in a position where you've got a loss, and it might be that you've got you've got an accounts profit but a trading loss, you might be able to carry that back and get some much needed cash flow into the business. Kickstart scheme update. So that's to do with apprenticeship placements. I'm not going to talk about that because I do want to finish quickly. Links in the email about that, but that's about employing young people and getting support from the government to help fund that. So that's it for today in terms of the coronavirus update and budget update and things like that. I just wanted to finish though on a really great article that was posted yesterday by Jane Treslow, one of our managers of the team. She posted on LinkedIn an article, Common Mistakes on a VAT Return. And I thought it was brilliant because we do lots of accounts, obviously, we're accountants, so we do lots and lots of accounts. For some clients, we do the bookkeeping for as well, and we help them with their VAT returns. And it's perceived often as too expensive. Accountants, firms like us, our charge out rates are too expensive when we're doing that, what's perceived to be quite basic level routine work. I'm going to do a survey around the office to find out what percentage of accounts that we prepare where the client have done their bookkeeping themselves, what percentage of those accounts have VAT errors on, because I reckon it's massive. I reckon most clients are making quite basic errors in the VAT returns, and I'm going to quickly run through the sorts of things that we see often and just challenge the fact that just talked earlier about penalties for income tax late returns. Penalties for incorrect VAT returns are also going to be changing and getting higher fundamentally in the next couple of years. And so it's that peace of mind thing, so anyway, you might have to pay a little bit more than doing it yourself, but what's the price of peace of mind? An error on a VAT return could cost you 100% of that error. So if the error is £2,000, it's going to cost you £4,000 because you need to pay the £2,000 back plus £2,000 again in penalties, plus interest, plus the stress and anxiety of dealing with HMRC. So quickly going to run down the common mistakes on a VAT return. Poor record keeping, basically. You cannot reclaim VAT without a valid purchase invoice. So an email from a customer, from a supplier, saying this is going to cost you £200, including VAT, that's not enough. You need a VAT return. You need a VAT invoice. And you can Google the key things that a valid VAT invoice needs to have. And HMRC, in the event of inquiry, will be all over that. The key thing, there are several, it's not just this, but you need a VAT number and you need the VAT rate and the VAT amount to be shown. So just the letter from somebody saying, here's the quote, it includes VAT, it's not going to be enough. A quote's just not enough, even if it shows a lot of things, it needs to be a valid invoice. And there are ways of capturing that information really easily. So the Receipt Bank, for example, and HubDoc, and there are others, capture that information and store it securely. So when HMRC make an inquiry 3 years down the line, and they can go back 4 years initially, when they make that inquiry, you've already got it stored electronically, rather than crumpled up piece of paper at the bottom of the drawer, which you'll never ever find again. Partial exemption rules. So some businesses have different types of supplies. Some of them they charge VAT on, some of them they don't. If you're not charging VAT because that is an exempt supply, you cannot recover all of the input VAT that you incur. Now, that's a sweeping generalisation comment. The rules are much more complex than that. So if you are invoicing customers and you know that sometimes you don't charge them VAT because that supply is exempt, you need to understand the partial exemption rules to make sure that you're not overclaiming on the input VAT that you have paid to your suppliers. Failure to pay over VAT on deposits on receipts. So I talk quite a lot on this check-in about hospitality, pubs, restaurants and things like that, because we have lots of clients in that sector and they take deposits. If your client has paid you a deposit, you need to charge you need to pay the VAT over on receipt. We see often just that not being done. Not spotting the requirement to repay VAT previously claimed on unpaid invoices older than 6 months old. So you've received an invoice from a supplier, you're on accruals accounting, so you can recover that VAT based on the date of that invoice. But if for some reason that invoice isn't paid by 6 months later, and sometimes they aren't, then you've got to pay the VAT back. Incorrect posting of exempt, so finance charges or zero rated transactions, cakes, Jaffa cakes. You know, that sometimes your accounting system defaults to a VAT rate, and you need to check that it's defaulting to the VAT rate, because you might have something that most of the things that get posted to a particular nominal code are 20%, but sometimes they're not. So you need to be checking that you're picking up the right rate. Land and property not being accounted for correctly. This is a minefield. It's huge. Option to tax determines whether or not you charge VAT on rental income, and we see that a lot with just when I talked about putting the wrong rate of VAT in when you put expenses through. Just because you're paying rent doesn't necessarily mean there's going to be VAT on it, and that's probably one of the areas where we see a lot people are reclaiming VAT on rent, but the landlord hasn't charged VAT because there isn't an opt tax in place. There are rules, different rules if it's a furnished holiday let compared to a residential let, and if it's a residential property or a commercial property. It's an absolute minefield. And the last one, VAT incorrectly claimed on business entertainment. So just because you've got a VAT invoice and it says, and it ticks all the boxes, it's a VAT receipt, doesn't necessarily mean you can reclaim that VAT. And VAT entertaining is a big one that people often claim the VAT on when they're not entitled to. And there are others as well, but that's the main one. So on that cheery note, I'm going to wrap it up for today. So thanks for checking in. I've got a good number today, which is nice, and 1 or 2 new names, which is a bit scary. So hopefully you learned something, might be a little nugget to take away. Give us a call the office, call your normal contact, send us a LinkedIn message, email or whatever. Do reach out, be happy to talk you through anything that might be specific to you. Otherwise, I will leave it there and see you next week. Bye.